up, everybody? Welcome back to Royal Blu FX. In today's video, we're going to talk about why mitigation is so important in Forex or any other type of markets, so stay tuned. If you're a new member to this channel, please consider subscribing to this channel because we always give out free, valuable content on this channel. Also, if you have not been consistent with your trading and you're losing all the time and you just don't know how to trade, or at least don't know how to be consistent in trading, please consider our online academy at RoyalBluFX.com. You can find it right here at RoyalBluFX.com. Go ahead and start today with us. Obviously, our online academy differs than the videos here on YouTube. We definitely go through a lot of details and examples and show you step by step on how to trade. So without any further ado, let's begin. All right, so this video is going to talk about why mitigation is so important in Forex. Now, it's going to be a lot of lecturing, but also a lot of examples here that we're going to be showing you guys how price mitigates and why price mitigates. And it's really important that you know this because a lot of the times I feel like a lot of people out there just don't understand what mitigation is or what the mitigation process is and why mitigation is happening, right? All you've been taught is, you know, when price breaks structure, price needs to go and mitigate an order block. And you're like, okay, I see an order block, but I don't know which order block it is, and I don't know what the word mitigation means and what the purpose of mitigation is, right? So this video is really going to go break it down step by step and tell you psychologically also how mitigation is used and why it's used in the markets, specifically for those people, the new people here on this channel that have learned or are learning some form of trading. All right, so let's begin. All right, so what is mitigation? What does mitigation actually mean? Well, in Google, it says this: the action of reducing the severity and seriousness or painfulness of something. Okay, so let's think about this. Painfulness or seriousness of something, okay? Something will be painful and serious, okay? But let's put this in the market's perspective, okay? Let's think about the markets and how mitigation applies to the markets, okay? So let's just say, for example, when price is going bullish like this, all right, price going bullish, and all of a sudden price breaks bearish like this, okay? Okay, so what is happening here? Okay, prices went bearish all of a sudden and never respected this structure here, never respected this low. It just broke right through it, right? So what the banks are trying to do here are trying to see whether they're going to make a decision on going back up to close the last order, okay? Now, why do they want to go and close the last order? Well, that's because the last order, they are negative. Okay, they're actually negative. So in this case, over here, you can see that this up move or last bullish candle here is our last up move before the major move pushed down, right? This is the last order that the banks have made. So theoretically and psychologically speaking, banks don't have the way traders have, the retail traders have a way of trading, okay? They don't have a stop loss above or below every high and low. They have so much money in the markets to the point where they can continue buying and selling, buying and selling, buying and selling. They have what is known to be open orders in the markets. They have a lot of open orders, okay? So when they're buying here, they're also selling. When they're buying here, they're selling here. When they're buying here, they're selling here, okay? And the reason for this is because their amount of capital, they have way more capital than any of the retail traders would ever have, okay? And the reason why, obviously, is if you understand this, the markets are moving only because of the bank's capital. Money moves the markets, right? That's the only thing that's the only way the markets move, is because of money, okay? So let's take this in perspective. This last up move here is right over here, right? When prices went bearish, we have that last up move. So now what do the banks want to do? Well, they are like, hey, okay, we have so many open positions in the market, therefore we need to go and close one because we're thinking to go and change the direction of the market, all right? So what banks are wanting to do here is they push price back up, right? Notice they bought here at the slow because they can, and they have the money and the means to, obviously, right? They have the money and the means to push price bullish back over here to now want to close this last up candle, right? Or the last up move before the major move pushes down, okay? Now, why do they want to do this? Here's the psychology part of it, okay? The reason why they want to close this last order is because they want to continue the direction bearish, okay? So if we picture this, if price was like this, coming from a bearish perspective, right? Like this, what's happening is price has been pushing bullish like this, and prices have been mitigating another previous order block, say this, for example, okay, right over here. So what banks are doing here is they're going to close the last order because they don't want to continue the trend bullish, right? And then once they close that last order, they're also they're wanting to change the direction bearish again. They want to continue the direction bearish from this long area here where prices have gone bearish on a major structure, right? So again, they're pushing bullish here to close the last order. Now once they close this order, what they're trying to do is continue the direction in a new direction, right? So now, what are we talking about here? Now, once prices have been closed here, right, what do you think is happening here? Let's go back and think about the word mitigation here. What are the banks trying to do? The reason why they're closing the last order is because they don't want any seriousness or painfulness in the market, right? They don't want to. Nobody wants to lose, right? And the banks are definitely not in this trading in this game of trading just to lose. They're not here to lose, obviously. They're here to win because they always win. Okay, so this is the meaning, and this is the meaning behind mitigation. When prices retrace back to the last up candle like this, banks are closing the last buy order because they don't want any pain, any seriousness or pain for them to lose this money, right? So instead, now prices are continuing bearish now, and now banks continue doing this over and over again, right? Notice there's a break of structure here. Right, there's another break of structure here. What do the banks do again? What are they trying to do? They're going back up and continuing price bearish. Why? Because they're coming to mitigate their last order block here, mitigate it, and continue price bearish. Okay, nobody wants to lose money in the market. So how can we trade with the banks? Well, if we think about this scenario, okay, whenever you see structure forming, right, always think to yourself, when there's a break of structure, price needs to come back and retrace about 80 to 90% of the way in the markets and mitigate that last buy order in here, okay? And in another case, prices can obviously go and switch up and do this, all right? Start going bullish like this. Now we've broken this structure, and if the banks decided to continue going bullish, they need to do what? They need to come here right now because this is the last down move or down candle before the major move pushed up, right? Now they're closing the last down order, right? And then now this is the decision making here. Is price going to actually push bullish here? Or is it going to continue bearish, right? Sorry everyone, I had to cut that video short due to interruptions. So speaking of decision making, we need to talk about when price comes to an area of supply or demand, which is your order block, all right? And when price mitigates, that is considered to be a decision-making area, okay? All right, so let me elaborate in terms of what I mean, okay? So let's go down, all the way down here. Let me just move this here. All right, so when prices are going bullish, okay, and all of a sudden prices are going bearish like this, right? Prices are coming back to an area of supply right here. You can see that when prices get to an area of supply in this case, this is the decision-making area. This is the decision-making zone. A lot of people normally say, okay, well, I'm looking to sell here as soon as price comes and taps my order block, right? And then I'm looking for the sell like this, right? Well, it's true and it's not true to some extent, okay? And let me elaborate and let me tell you why. The reason why you shouldn't be taking an automatic sell like this, in this case because price is bearish now, right, is because when price comes to an area of supply or demand, or to an order block, in this case too, okay, is price, or what price is doing. When I say price, I'm talking in terms of banks, by the way. The banks are trying to decide and decipher whether prices should go bearish or whether prices should go bullish from here, okay? So anytime you approach a supply or demand zone, always think to yourself that an order block, just because it's an order block, doesn't necessarily mean that prices or the banks will respect this order block and or hold this area of supply and then continue bearish, right? This is why we always talk about, hey, when price goes to a supply or demand, always look for confirmation. That confirmation typically means that you're looking for a sign, a chalk, okay, a change of character, something like this where price breaks the high, then price breaks the low, right, then comes back to an area of supply like this again, and then take the sell, right? So when prices do come to these supply and demand zones, always look for, or always think in this case, that prices are trying to decide where they want to go next, okay? Prices could easily go tap the supply zone, come right here, right, do a little head fake, right, and then start pushing bullish like this, and then you wonder to yourself, oh my gosh, but this was the last up candle before the major move pushed down, right? We had to break a structure. Price never respected the supply zone, therefore, you know, price came up to the supply zone and now it didn't respect it. What did I just do? I just took a sell from this supply zone and now now I just lost this trade, right? Well, this is again because we always need to think about when prices go to a supply or demand zones, they're the decision making area, okay? So this is when we think about decisions, we have to think, okay, now what do I need to do? We know that the banks are coming here now either to close this last buy. Okay, they could either close it like this, right? Maybe do a little pump fake like this, and then continue the direction bullish. Now when the direction's bullish, right, breaking a new high, where is that last down candle, right? What do the banks need to do? They need to obviously come back down to this area here. This was the last down move or the last down candle, right? Before the major move pushed bullish. Now this area here is considered the last down candle. Now this is where the banks need to close their last order. Banks have mitigated, right? Banks have mitigated their last down move, and now we're looking for banks to continue to push price bullish like this, right? So it all makes sense. Everything makes sense. It just really just depends on where your perspective on what you're looking at in terms of perspective, right? The perspective of the markets, right? You can see, we can obviously and evidently see that prices are bullish here, right? So obviously this move also makes sense, right? In terms of price pushing bullish here because everything looks bullish. Nothing has gone bearish just yet, right? But also, it also makes sense that prices can obviously come and respect the supply like this and then continue bearish like this. All right, so every time you approach that supply or demand zone or that order block that you think price is coming back to that order block, always think to yourself, is this area going to hold, right? Is this supply zone going to hold? And this is obviously, I have to think to myself, this is the decision area. This is where the banks make that decision whether they're going to go bullish or bearish. Okay, I know I keep repeating myself here, but I think it's also good for you guys to understand what I'm talking about, so you guys can have this implemented into your heads, obviously. So that's how banks are deciding whether price should go bullish or bearish based off of that order block, based off that last up move or down move. Okay. Again, I want to reference on why price is mitigating. Okay, banks know they have so many orders in the markets, right? Everything is a buy or sell for them. They have bought and sold, bought and sold, right? They have to decide where price is going to push based off of that last order block. Okay, all right, guys. So what I'm going to do here is go in the live chart and show you a few examples just to kind of show you, obviously how the mitigation process works, right? The mitigation process is so important to all of us, and we all need to abide by it and see what the banks are trying to do. All right, so I'm going to go right now into the live chart. This is going to be a fun little exercise that we go through together. Obviously, I'm going to show you guys how price is going to mitigate. When it mitigates, what it does after this, okay? So let's just go here. We're on the 4 hour right now, right? Let's just even look at this this swing over here, okay? You'll see when price breaks structure, right there's a break of structure, right? Price is coming to mitigate the last down move, right over here. Now you can see this is a down move, not the last down candle. Now essentially on the higher time frame, if you go on the daily, this is your last down candle right over here. Let's go over here. Let's go zoom over here. You can see over here on the daily, this is your last down candle right here, right? Price goes up, comes and mitigates it and pushes price up, right? Let's go down back to the 4 hour. Let's continue here. You can see the reason why it's coming to mitigate is only because the banks want to close their last order, right? It doesn't want to hurt itself in severity, right? It doesn't want to have any losses in the market, right? It wants to come down and close this before prices continue bullish, right? So right here we notice that prices have been closed. Prices push bullish again here, right? Break a structure, right? Where's the last down candle? It's right down here. You can see prices are doing the same thing over and over again. They're mitigating, right? What is the process of mitigation? The mitigation, psychologically speaking, is banks want to close their last order, right? And when they want to close the last order, they don't want to be in a painful situation here. They don't want to lose, right? So what they do is come down, stop, close their last order, and continue bullish, right? Let's look over here, right? You can see here prices have broken the high right here, right? And then where's the last candle? Down here, right? Price broke, mitigated, continue bullish, all right? It's the same process over and over again. Now, obviously, when you have this break of structure, we would anticipate for price to come back down here, although it hasn't, right? So what we're waiting for is for price to make either a new high, right, or for price to come and mitigate, right? So we know this area here has not been mitigated. Let me make this a little more cleaner right here to show you guys. Right there. Let me just get that out of here. Right there. We know this demand area here, this order block here, has not been mitigated. Therefore, it's an open area. We're waiting for price to get there eventually to mitigate, okay? Right here, we had another push to the upside, more demand, right, for price. We're coming here, and we can actually see that price was not mitigated here either. Right there. There's the last order block, okay? So we know price has not been mitigated there. Okay, so now these areas are open positions, meaning price will eventually, or the banks will eventually have to come here and close these because they're going to work on probably reversing price somewhere else. Okay, let's look over here. You can see that this area here was not mitigated either, right there. Okay, so we have another open position. Here's another down candle right there. The last area, the last down candle before major price moved up. You can see we had a break of structure. The banks have finally made their decision to come here now and close this area. Now when we get to this area of demand, what do? Do we place our demand zone like our risk to reward tool like this and start taking a trade bullish just because price came down here to our demand zone? No, we don't. What we want to do is scale down to the lower time frames and now look at the behavior on the lower time frames, right? What we're trying to do now is see what the banks are trying to decide, right? This is where all the orders are switching, right? Banks can either manipulate you, right, by creating a lot of liquidity like this. And when they're creating a lot of liquidity like this, this is where a lot of buyers and sellers are trying to decipher whether the market's going to go up or down. This is obviously a sweet area, a really juicy area for banks to say, hey, yeah, keep buying, keep selling, keep buying, keep selling, but we know where we're going to take the next. We know where we're going to take the market next, right? And this is not for us to decide where it's going to go. This is for the banks to decide where they're going to go. And once we see if price goes bullish like this aggressively to the upside, we know clearly that the banks have respected this demand zone, right? They've respected this demand zone and then have pushed bullish aggressively like this, right? And if they have, we know that retail traders can't make this move. It's only the banks, right? They're making this decisive move, right? They're pushing it bullish and saying, hey, we're gonna go up now, all right? And what the banks have done now is cleaned out all this liquidity, this buy-side liquidity where all these sellers have tried to sell, right? Banks have pushed bullish, and now what do? We are looking and anticipating for prices to come bearish here now. Why? Because we're looking for that last order block here, that the last down candle right over here, for banks to close this last down candle and then push prices up, okay? And this is where our buy opportunity would be. The buying opportunity would be here, right? Then we would hold this, either TP at this high as far as partials go, and then we can look to TP here at the highest, this last high over here, okay? So this is how we look at how mitigation works, okay? The mitigation process, just because price is coming down to an area of supply or demand, doesn't necessarily mean that price is going to hold, right? And that confirmation that we're looking for is when price actually breaks a new high, like so, right? Here you can see price is breaking a low, sweeping liquidity to the downside, sweeping liquidity to the upside like this, right? And then we're looking for price to come back again to close the last down candle before prices push bullish like this. And this is how you guys will know what the banks are doing, right? Psychologically speaking, this is what you need to understand in terms of mitigation. Now, let's just say in this case, price doesn't respect this demand zone, right? And pushes bearish like this. What do you see? Okay, well, we can tell that prices did not respect the demand zone, right? And now prices are most likely looking to go bearish because now we just broke this low like this, right? And then now you can see, well, where was the last up move before the major move pushed down? Well, you can see it was right here, Okay, a lot of you guys would say it's here, which is true to some extent, but in order to continue the trend, if you were looking to sell now, this here is the last up move before the major move push down, because now prices, you can see here, there would have been an aggressive move like this, right? Aggressive supply coming in, and then this would be considered our flip zone here, where prices come here, mitigate at this high, and then close the last up move or the last up candle here before the major move continues bearish like this. Okay, so price will continue going bearish like so. All right, but eventually, if prices, we could say that prices have broken this low here like this, it could come here, mitigate, and continue pushing bearish, but then it could also decide to come all the way back up here like this, because now we're going to be working on our major structures mitigation, right? Now we're looking to mitigate this high, the extreme high, right? So something like this, right? And then we can look for, on the extreme high, we can start looking for prices to potentially come and close. You can see that prices have come and closed by the banks here, right? They're closing the last buy, because now they want to come and continue selling price even lower like this, okay? So just think about this, guys. Whenever you come to an area of supply or demand, it's where prices are mitigating, and it's where prices are trying to decide, are we going bullish or bearish, okay? So I hope you guys like this video. If you did like this video, please throw a huge thumbs up. Obviously, consider subscribing to this channel, because we always give out free content, guys. I love you. I will see you in the next.